Hello, and welcome to Mayor Brown's webinar on transfer pricing documentation in a post-BEPS world, evolution or revolution. I'm Scott Stewart, a partner in Mayor Brown's Chicago office and a member of the tax controversy and transfer pricing practice. I represent taxpayers at all levels of federal tax controversy, including audits, administrative appeals, and litigation before the United States Tax Court, with a particular emphasis on transfer pricing. Joining me today as co-presenters are partner Astrid Piron and Director of Transfer Pricing and Valuation Services Elena Kripanova. Astrid leads the Mayor Brown European Transfer Pricing Center, which coordinates transfer pricing strategies and controversies in Europe. Her practice covers counseling on the transactional aspects of transfer pricing, tax optimization of mergers and acquisitions, structuring of investment funds, and general assistance to private equity deals. Elena, located in Washington, D.C., has over 17 years of transfer pricing, valuation, and general quantitative analysis experience. She has performed transfer pricing and valuation analyses for purposes of advanced pricing agreements, tax planning, contemporaneous documentation, audit defense, and litigation for clients that range from some of the largest multinational enterprises in the world to privately held companies in a wide range of industries. Before we begin, we'd like to mention a few housekeeping announcements. First, as noted under the FAQ widget on the right side of your screen, today's program is being streamed through your computer, so there is no dial-in number. For the best audio quality, please make sure your computer speakers or headset are turned on and the volume is up so you can hear the presentation. With that, let's get started. Let me start by briefly giving some historical context for today's presentation. A couple of overarching trends are worth noting. First, for many years, transfer pricing audits were viewed, and maybe rightly so, as a dance between a taxpayer and the taxing authority of a particular jurisdiction, often the United States, to the exclusion of a larger global context. Needless to say, this situation has been changing with the adoption of BEPS principles by the Organization for Economic Cooperation and Development over the past several years. Moreover, the rate of change in this regard has accelerated rapidly over the past couple of years with the adoption of country-by-country reporting and automatic exchange of information, topics we'll talk more about today. To the extent that taxpayers in the past viewed each transfer pricing audit in isolation, in the current environment, a taxpayer would do so at the taxpayer's peril. Rather, taxpayers would be well advised to bear in mind the profits across its entire supply chain in setting and documenting its transfer pricing policy. A second trend is also worth noting. For many years, at least some taxpayers focused primarily on ownership of intangibles and financial responsibility for risks in setting transfer pricing policies. While in the past this approach may have been a bit myopic, in the current environment this approach would be potentially quite risky. The OECD has made clear in its BEPS reports that it is at least as concerned about the taxpayer's ability to make relevant managerial decisions in a particular jurisdiction as it is about ownership of intangibles or funding of risks. For this reason, taxpayers would be well advised to focus on the location of management activities in addition to the location of intangible assets and funding of risks. With regard to transfer pricing documentation, the primary topic of today's presentation, in the past, local country management was often permitted to address transfer pricing documentation on its own with little centralized coordination. With the advent of the transfer pricing master file, local file, and country-by-country reporting, topics we'll be exploring today, the case for centralized coordination of transfer pricing documentation becomes much stronger and potentially overwhelming.
Before discussing transfer pricing documentation, I would like to quickly go back to the BEPS action plans. As you may see from this slide, the 15 actions were around three main pillars, and transfer pricing documentation was under the pillar Transparency and Certainty, BEPS Action number 13. So it's really important to remember that the purpose of transfer pricing documentation was providing transparency for tax authorities, but also certainty for the taxpayer. The BEPS report includes recommended changes to domestic laws, the OECD Transfer Pricing Guidelines, and the OECD Model Income Tax Convention. This means that the proposed BEPS changes are not self-executing. They depend on action by the participating countries. And the participating countries are not only the OECD member, but also all the members of the inclusive framework. So this means also that we have to watch multiple levels, the domestic legislation, the EU legislation for the European region, and the treaty law. What documentation means in a post-BEPS era. It is clear that BEPS brought a sharper focus on legal documentation and legal framework, meaning that the need for having a robust legal framework is more than ever important. Regarding the technical transfer pricing documentation, we should also see that not only a challenge, a compliance challenge, but it becomes also a tool to support the group's transfer pricing policy, to support the position of the group itself. And importantly, documentation in its two legs, so documentation, legal framework, and transfer pricing analysis, which are important for the identification and characterization of the transaction, should speak together. Both legs should be aligned.
So before we get into the details on Action 13, a bit of history. Transfer pricing documentation requirements were first introduced by the United States in 1994 and were closely followed in 1995 by Chapter 5 of the OECD Guidelines. At that time, which was almost 25 years ago, tax authorities and taxpayers alike had little experience with transfer pricing documentation. While cross-border transactions have always had international context and global scope, the documentation rules were local, enacted in individual countries, and were most often approached from a national perspective. As a result, documentation requirements varied significantly from country to country, so much so that for a single cross-border control transaction, taxpayers often had to comply with two or more sets of rules. Also, a common element of country-specific documentation was the adoption of one-sided analysis of a controlled transaction, focusing mostly on domestic side and ignoring the other results of the related counterparties. As a result, documentation did not always yield a complete understanding of the global business, and tax administrations often found documentation to be less than fully informative and not adequate for their risk assessment and tax enforcement needs. As the number of countries that require transfer pricing documentation grew and as the volume and complexity of international transactions increased, it became clear that greater coordination between countries was of paramount importance. Certainly, there have been efforts in the past at an international level to standardize transfer pricing documentations, but these initiatives have not produced actionable outcomes until now. So enter BEPS Action 13, transfer pricing documentation and country-by-country reporting, finalized in 2015, and the OECD Transfer Pricing Guidelines, Chapter 5, released in July of 2017. The guidelines define three objectives of transfer pricing documentation. First, to ensure that taxpayers give appropriate consideration to transfer pricing requirements in establishing transfer pricing and reported the income from such transactions on their tax returns. Two, to provide tax administrations with information necessary to provide risk assessment. And three, to give tax administrations information to allow them to audit transfer pricing practices and transactions in their tax jurisdiction. In addition, OECD guidelines provided guidance on implementation of transfer pricing documentation requirements and also provided information sharing mechanism between tax administrations through a multilateral competent authority agreement which defined the scope, timing, procedures, and safeguards according to which the automatic exchange should take place. The three objectives of transfer pricing documentation are met through a three-tiered approach which consists of a master file, a local file, and a country-by-country report. A master file addresses global business operations and transfer pricing policies at a high level, and because the master file will be a part of transfer pricing package in all countries where a multinational operates, it will provide local tax administrations with better understanding of the company's global business and transfer pricing policies. And while there is no corollary to the master file in the Section 62 regulations, U.S. parent and multinationals need to prepare the master file anyway in order to comply with documentation requirements outside the United States. A local file for each jurisdiction where multinational operates addresses material intercompany transactions between local affiliates and related parties in other jurisdictions. These requirements are similar to the existing U.S. documentation requirements and to the local requirements in other OECD countries. Country-by-country reports, on the other hand, are a new requirement for all jurisdictions. The goal of the CbCR is to provide a glimpse into taxpayers' transfer pricing policies on a global basis and to assist tax administrations in their risk assessment needs.
The country-by-country report, the CbCR, is likely the most innovative component on the BEPS 13 documentation. It requires large groups to file the report in the country of residence of the ultimate shareholder, and large groups are defined as groups having over 750 million sales. It received a widespread implementation, likely because of the specific features. In fact, the local subsidiaries would be exposed if there is no evidence of a filing at a higher level, and they need to notify who will be preparing the country-by-country report. So there is a kind of check both sides of the ocean, by example, whether this group is compliant with the local requirements. The regulation generally adopts the guidelines set for under BEPS Action 13 and the template report. The country-by-country report, in fact, is more a form than a real report, but it contains very significant information, as we will see in a minute. And the goal, as Elena said, is to facilitate the risk assessment by the tax authorities in each jurisdiction where the group has operation. But what we see after a year and a half implementation is divergence in implementation. For example, there are meetings in China recently between the business community and the tax authorities to start a dialogue in order to prevent misuse of the report. And the OECD claims that they will be monitoring the process and the implementation and offer training for the tax authorities of the different countries so that with the purpose again to prevent misuse. Let's have a look to the CbCR report, so the famous form, which is two parts. One is giving information on the figures, the sales, the revenues, the income tax paid in the countries where the group has operation. It's certainly a tool for the tax authorities as it's providing information such as the employees in those different countries or the tangible assets invested and used for the operations. It can also be seen as a tool for the taxpayer to identify the risk areas and improve the tax structure they have in place to make sure that it's still robust in a post-BEPS context. If we look to the second part of this country-by-country report form, I would call it, you will see that there is identification of the functions taken by the different entities in the different jurisdictions. So you can clearly identify for this case that you have in Ireland, where there is 15 people, quite a lot of functions. There are research and development, intellectual property management, production, and distribution. Maybe raising some questions, both for the taxpayer and the tax authorities.
As has already been mentioned, one of the most significant developments of the past couple of years is the potential for automatic exchange of transfer pricing documentation, particularly the country-by-country reports between countries. Reports are exchanged either pursuant to a multilateral competent authority agreement or by substantially similar bilateral competent authority agreements entered into under the authority of a tax treaty or a tax information exchange agreement. BEPS Action 13, which mandates the exchange of country-by-country reports, is not self-executing but must be done pursuant to an existing instrument. Currently, 1,800 activated agreements include exchanges between the 74 signatories to the country-by-country multilateral competent authority agreement between EU member states and between signatories to bilateral competent authority agreements for exchanges under double tax conventions or tax information exchange agreements, including over 35 bilateral agreements entered into by the United States. The United States is not a party to the Multilateral Convention on Administrative Assistance in Tax Matters. Rather, the United States has chosen to go down the bilateral exchange route. In the United States, country-by-country reporting data is exchanged pursuant to bilateral competent authority arrangements, which rely on double tax conventions, tax information exchange agreements, or the Convention on Mutual Administrative Assistance in Tax Matters that permit automatic exchanges of information. The IRS started to exchange 2016 country-by-country reports in June of 2018.
The master file is expected to assist administration in evaluating the presence of significant transfer pricing risk. So this is the second component of the BEPS 13 documentation. And that goal is quite evidenced by the requirement. It's a lot of narrative, a lot of facts, information about the groups. There is no economic analysis and defense of the transfer pricing per se. So what we have in the master file is a chart demonstrating the group legal ownership structure, the location of the operating entities. We have a description of the business, which can be quite sensible information, including the profit drivers, the supply chains for the most important products and service offering, with the main geographic markets, the important service arrangement, and important business transactions. Two important chapters are covering the new focus of BEPS, which is intangible on the one hand and the financial activities on the other hand. Regarding intangible, they are really willing to highlight through the master file the strategy of the group for intangibles, the location of the R&D facilities and the management of them, the list of the group intangibles that are important for the transfer pricing purposes, and a list of the important agreements related to intangibles. Regarding financial activities, we will see the same request for information, meaning the strategy for financing, including how is the group financed from external means, where is the group treasury center, the finance companies of the groups, or where they are managed, also the transfer pricing policies applicable to related party financing arrangement. And finally, they are asking for disclosing the group financial and tax position. The local file is much more a defensive file for the taxpayer. It is, in fact, the evidence that the taxpayer has complied with the arm's length principle in its material transfer pricing position affecting a specific jurisdiction. Normally, you have a local file per entity, not per country, but per entity. So if you have different business units, it can be quite, I would say, a challenge to align all your local files. It's why you can have a modular system to help you in managing those files. The local file requirements are quite common requirements if we see the history of transfer pricing documentation across the globe. So you need to have a description of the local entity management structure, the local organizational chart, a detailed description of the local entity business, the business strategy, the key competitors, what can be also a sensitive information to be provided in this file, and the market where they operate, also information to provide the market context. And after that, there is a chapter on the intra-group transaction, so detailing the material control transaction, the description of the transaction, the context in which they occurred, the amount of intra-group receipt of payments, so the value of those transactions per transaction category, and identifying the tax jurisdiction of the payer and the tax jurisdiction of the recipient, and also a detailed comparability and functional analysis of the taxpayer and associate enterprise related to each category of control transaction. This detailed comparability is more detailed than in the past, meaning that a matrix evidencing the respective role of the two counterparts is not enough. Most of the time, a narrative is required evidencing the role, either entrepreneurial role of limited risk role of each of the parties involved in that transaction. And finally, of course, identification of the most appropriate transfer pricing method per category of transaction and how is it being applied. Finally, of course, detailed financial information for the local entity has to be provided, as well as the summaries of the relevant financial data for comparables.
We will now briefly look at the impact of the new documentation requirements in the United States. We start with a mention of penalties because traditionally the purpose of transfer pricing documentation in the United States was penalty avoidance. Section 66, 62E and H provide penalties of 20 and 40% on increases to taxable income arising from Section 42 adjustments. When first enacted, the purpose of transfer pricing documentation rules in the United States was to make sure that when taxpayers completed their tax returns, they adopted considered transfer pricing positions. Without the documentation, what could happen in some instances is that taxpayers would put aggressive numbers on tax returns, wait for a government challenge, and then develop a theory after the fact to rebut the government position as arbitrary and capricious. The objective of transfer pricing documentation was to require that taxpayer adopt a transfer pricing method based on a thorough functional and risk analysis and demonstrate through its transfer pricing documentation that it had taken reasonable steps to comply with the arm's length standard when filing its tax return in order to avoid penalties. So in order to demonstrate compliance and avoid penalties, taxpayers need to reasonably select and apply transfer pricing method, a specified transfer pricing method, has contemporaneous documentation containing certain principal documents, and provide that documentation to the IRS within 30 days of a request. These requirements are not affected by Action 13. In the next 3 slides, we listed the 3 tiers of the new OECD documentation requirements in a descending order from the most novel to the least novel as far as the U.S. documentation is concerned. In order to comply with the CbCR requirement, the U.S. issued Treasury Regulation Section 6038-4, applicable to tax years that began on or after June 30, 2016. Pursuant to this section, every ultimate parent entity of a U.S. multinational enterprise must make an annual return on Form 8975, which is an equivalent of the CbCR. Consistently with the desire for standardization, the information required on Form 8975 and BEPS Action 13 is identical. Part 1 in the Form 8975 asks for the same data as Table 1 in Annex to Chapter 5 in the Transfer Pricing Guidelines, as well as Part 1, constituent entity information on Form 8975, has the same main business activities as Table 2 in the Chapter 5 of Transfer Pricing Guidelines. The IRS was expected to start sharing CbCRs as of this past summer of 2018, and we're yet to see how well the process works for tax administrations and taxpayers. For taxpayers, CbCRs is reported to be the most resource-intensive element of the 3 tiers. As Astrid mentioned, MasterFile is expected to assist tax administrations in evaluating the presence of significant transfer pricing risk. And while, as we mentioned earlier, there is no corollary to the master file in the Section 6662 regulations, U.S. parented multinationals will need to prepare the master file in order to comply with documentation requirements outside the United States. But the U.S. multinationals are not newcomers to transfer pricing documentation, so why the concern about the master file? Well, a global overview of a multinational's business as required by the master file can reveal sensitive information about its supply chain, business operations, intangibles, and financial and tax positions. And the concern is that the required information is far more than what the multinationals would normally include in their documentation in the past. And importantly, while CbCR is provided only to the parent country and then distributed through existing treaty frameworks, the master file will be directly reported to countries in which the multinational operates. So what is there the taxpayer can do? Well, when we advise on master file preparation, we pay heed to the words high-level overview, in that we start with broad strokes and add details as we deem necessary, because, according to Transfer Pricing Guidelines, quote, taxpayers should use prudent business judgment in determining the appropriate level of detail for the information supplied. And to us, prudent business judgment includes both the resource constraint and consistency of the disclosed information. So we take a balanced approach to make sure the reported information is not harmful if publicly disclosed. The information required in the local file is designed to supplement the master file and to help meet the objective of assuring that the taxpayer has complied with the arm's length standard in its material transfer pricing positions in a specific jurisdiction. The local file requirements are not new to the U.S. taxpayers because they are similar to the requirements in Section 6662. However, now that the U.S. multinationals have to provide the master file in jurisdictions outside the United States, the trend that we see is that the segments we would previously include in the U.S. 6662 documentation now make their way into the master file and are included in the local file by reference, thereby creating a more uniform look in the local file. This all means that even though the U.S. has not formally adopted the master file and local file requirements, these requirements nevertheless have made their impact on the look and feel of the U.S. documentation.
In Europe, transfer pricing documentation is not new. Since 2006, we have the European transfer pricing documentation package, which are guidelines to the European member states, which is in fact a political commitment among the different member states. And this has the purpose to prevent litigation in Europe, as litigation has been seen as an obstacle to the single market. So those guidelines were given a standard master file and a standard country file across the European Union. This has been implemented in national law provision, such in France, Italy, Spain, or taken as best practice by the administration, like in the UK, Belgium, or Germany. In most cases, penalties apply if not compliant, but of course only when there is national law provisions. And there is a specific case in Italy where there is a penalty waiver. In fact, you have to notify that you are under control on documentation, and if there is subsequent adjustment in the frame of a tax audit, there is no penalties, but it's always good to take. After BEPS, the situation doesn't change much in Europe, even though there is a third layer, being the country-by-country reporting. And you see some countries have all the old formats of the European TPD. So the master file with the full details of the transactions and the economic benchmark, and the local file focusing on the transaction in a specific jurisdiction. Some others, mainly those having no legal requirement in the past, introduce, copy-paste the BEPS 13 format, with the master file being more, I would say, descriptive, and the local file evidencing and supporting the position of the taxpayer and justifying the arm's length character of the transactions. The objective in both cases is to increase transparency vis-à-vis the tax authorities and to facilitate the risk assessment by them. But it can also be a good tool for the taxpayer to defend its position and its transfer pricing policy, also to defend and provide evidence of the functional analysis, including the description of the DAMP functions supporting the IP rights. So in Europe, 28 countries, 27 in the future is a challenge. You have a lot of unilateral initiatives what can in fact create a chaos. So what the goal of the European Union is to coordinate the implementation of BEPS, including on the documentation level. So we have a series of directives, which is in fact legislation, European legislation, which needs to be implemented by the member states within a certain time frame. We have, in fact, two big packages, I would say, being the tax avoidance package, ATAT 1 and ATAT 2, which is covering, I would say, the different topics like CFC, interest deduction, hybrids, and we have the tax transparency package. As Scott said, there is the automatic exchange of country-by-country reporting, and that is being implemented within the European Union through a directive in 2016. And we also have the automatic exchange of rulings, which is maybe nothing to do with documentation, but still you need to, the new format of the transfer pricing documentation, you have to disclose the APAs you receive in certain countries. So you have an additional layer of transparency through the automatic exchange of those rulings. And if my information are correct, we are about 1,000 rulings which has been exchanged to date. There is also a controversial proposal made in April 2016 by the Commission to improve transparency in making the CbCR public. That is, of course, that is not supported by all the member states, not at all. This is a political proposal to satisfy the public opinion looking for more transparency. And if adopted, it would require the multinational to publish certain piece of the country-by-country reporting on their own website. Till now, we discussed the technical documentation, the transfer pricing documentation, but an important part of the documentation is the legal framework. As said in the introduction, BEPS contribute to give a new focus on legal framework. It is always been, and it still reinforces the basis for identification of the commercial or financial relation. And of course now with a verification of economic reality, and I quote, to ensure that inappropriate returns do not accrue to an entity solely because it is contractually assumed risk of as provide capital. We can also note that the list of the agreements involving IPs is required in the master file. And in the local file, it's the best practice to provide the full copy of the intra-group agreements, unless there are two large sets of agreements, in which case you are providing samples. And also, in experience shows that in continental Europe at least, the agreements and I would say the rest of the legal framework, the invoice, the term and conditions surrounding the intra-group transaction are generally the first request from the tax authorities in case of tax audit. So BEPS is giving priority to economic reality when we need to identify the commercial or the financial relation. And an up-to-date set of intra-group agreements certainly serve as a first line of defense on the condition that the agreements duly reflect the functions, risk, and asset use as described in the master file and local files. So both should speak together. The functional analysis, including the risk allocation and asset use, should be, of course, periodically updated as required by the evolution of the group, which is different from group to group. Another tip is that the agreements detail the remuneration method. So, for example, if you have a cost pool or cost plus method, you need to identify the cost pool, the costs which are entering the pool, and the costs which are rejected from the pool. You can also provide the detail of the allocation keys used for the indirect allocation with a small narrative evidencing the link between the choice of that key and the benefit for the subsidiary. And finally, a narrative for the low value, what is the so-called low value services, which represent in fact the typical group services, marketing services, legal services, human resource services. Experience has shown in Europe that when you provide such a narrative, it serves as a good argument to evidence the benefit to the local subsidiary.
The last section of our presentation focuses on some recent legal developments that affect transfer pricing documentation in the United States. In the United States, exam teams continue to focus on transfer pricing issues. The IRS has recently issued 3 directives to examination related to transfer pricing issues, and these directives directly impact documentation. The first directive relates to the mandatory transfer pricing IDR. The standard transfer pricing IDR, which is essentially a request for the taxpayer's documentation, was formerly mandatory in all large case audits. Under the new directive, the standard IDR is generally only issued under 3 circumstances. First, an audit is conducted pursuant to an IRS campaign that involves transfer pricing. And generally speaking, the transfer pricing campaigns are not focused on large taxpayers. Secondly, the IDR may be issued if there are initial indications of transfer pricing compliance risk with respect to a particular taxpayer. Third, the transfer pricing IDR may be issued if the audit is staffed with IRS employees from the transfer pricing practice or cross-border activities groups. This directive may seem like a reprieve for taxpayers, but as we will see in a moment, the IRS is still very serious about quality transfer pricing documentation. The second directive relates to transfer pricing penalties. The exam team is instructed to carefully consider whether automatic transfer pricing penalties should apply with respect to a particular taxpayer. Merely having documentation is not enough to prevent application of penalties. Rather, documentation must establish that first, the taxpayer reasonably selected the best method, and second, the taxpayer reasonably applied the best method. Indications of unreasonable application of the chosen method may include, first, inaccurate inputs, second, failure to consider material information, third, failure to follow the best method rule, and fourth, results that appear to differ significantly from the arm's length result. Therefore, it seems that the quality of the taxpayer's documentation will be under greater scrutiny than ever before as the IRS weighs the application of transfer pricing penalties. The third directive relates to examination of the taxpayer's chosen transfer pricing method. Under this directive, exam is instructed to apply an initial presumption in favor of the taxpayer's chosen transfer pricing method. Exam is also directed to carefully examine the facts relevant to the taxpayer's intercompany transactions. Exam may make changes to the application of the taxpayer's chosen method, such as selecting additional or different comparable companies. Exam may also make changes to the taxpayer's chosen method itself in cases where exam concludes that a different method results in a more reliable result. In order to change the taxpayer's method, exam must seek approval from the National Transfer Pricing Review Panel. Again, the quality of the taxpayer's documentation will be under greater scrutiny than ever before as exam considers whether the method chosen by the taxpayer is truly the best method for transfer pricing purposes. Another statutory change is worth noting. The Tax Cuts and Jobs Act amended Section 42 to require the IRS to value intangible property, including intangible property transferred in connection with other property or services, on an aggregate basis, considering realistic alternatives available to the taxpayer. This amendment to Section 42 is generally consistent with temporary regulations issued in 2015. The goal of the temporary regulations was to ensure that all value transferred in interrelated transactions was adequately compensated. The IRS sought to apply the all value concept in litigation in cases such as Veritas and Amazon by asserting the aggregation principle to include multiple assets in its analysis. The taxpayers in those cases asserted, and the tax court agreed, that the commissioner had overreached by attempting to tax more than the value actually transferred in outbound transactions. But the IRS has appealed the tax court's decision in Amazon. The temporary regulations expired in September. However, taxpayers should assume that the IRS will continue to pursue the all-value concept by applying the statutory aggregation principle. Taxpayers should be prepared to demonstrate through their documentation that the taxpayer's chosen method is truly the best method available in the face of a potential assertion of an aggregation position by the exam team. Before we conclude, I'd like to summarize a few key points from today's presentation. First, taxpayers should assume that information provided to one jurisdiction will be routinely shared with other jurisdictions. Second, with this potential for information exchange in mind, taxpayers should coordinate transfer pricing positions among affected entities. Third, taxpayers should ensure consistency of documentation among affected entities. Fourth, taxpayers' documentation should provide the context of the taxpayer's business and transactions, particularly as it relates to country-by-country reports, in order to assist the exam team in understanding the taxpayer's transactions and its decision to apply a particular method as the best method to document its transactions in order to avoid the assertion of penalties. Last, a taxpayer should consider developing a risk assessment of its tax and economic positions that takes into account the profitability of functions and entities across the taxpayer's supply chains in order to assess the strengths and weaknesses of the taxpayer's transfer pricing positions and documentation, and to make any changes that might be appropriate. This concludes our webinar on transfer pricing documentation in a post-BEPS world, evolution or revolution. Thank you for joining us today. We hope the information shared was useful. Thank you for your participation, and have a good day.